This has been Reppond. Welcome to my YouTube broadcast. Today is February 19th, 2025. As you probably know, I was out last week ill, so I'm glad I'm back now. Was not doing well due to the flu, but glad I'm back 100% and able to do this presentation today. So I'll begin. This is a view. I start with my dashboards. And you can see this is as of last Friday, February 14th. And I put a list, top to bottom, the 6 different stock market indexes and the bond index. So I'll explain those. So there's in the list is the S&P 500, the Dow Industrials, the NASDAQ 100, Russell 2000, and 2 foreign ETFs, EFA, developed markets, and EEM, emerging markets, and then the long-term government bond, TLT. So it's kind of a really broad mixture of 6 equities and 1 bond ETF. In the yellow box is what happened last week. So during the past week, it was generally more positive than negative. And you can see there were, of the 7 indexes or ETFs, there were 5 of them that were positive and quite a bit positive, and 2 of them that were slightly negative, including bonds. In the pink box, year to date, they range, okay, so here we are, this is the 19th of February, so we're into the 3rd week. And we have equity gains of 8% going all the way down to 2%, and then even government bonds are 2% positive. So, and you can see the green dots and red dots to the right, and that shows that they're above or below their 20, 50, 100, or 200-day moving averages going from left to right. The Russell 2000 is the most negative. It misses 3 of those moving averages, and then the bonds miss 2 of them, but otherwise they're all green. The S&P 500 breaks down into 11 component parts, sectors, and these are the sectors. So this is kind of when you look at the S&P 500 number, you say that is what the S&P did today or this week or whatever, but below there is a lot of noise. A lot of sectors are going in different directions. So it's good, in my opinion, to look at the component parts of the S&P 500, realizing some are going up and some are going down. The yellow box is last week, and so you can see, just scanning down, that there are 3 of them that are slightly negative, and the rest are positive or slightly positive out of 11. In the pink box, this is year to date, all of them except 1 are positive. They go all the way from 7% positive down to 1% positive, and then retail is slightly negative. And again, you can see the red and the green. The red dots are below their moving 20, 50, 100, 200-day moving average, or they're above it, green dot. So the S&P 500, as you could see, I mean, I said this earlier, basically went up this last week slightly. And you can see that at the very far right, upper right, you can see that tick up, and that indicates that the market was elevated this past week using the S&P 500. And this is a 30-month weekly chart. Staying above that weekly moving average for over that 30-month period of time. Same thing, this just puts it in a candlestick chart, and you can see at the very far right that little candlestick that went up, that's a representation of this past week. On a relative strength basis, the NASDAQ 100 was more positive this past week than the S&P 500, the broad market. And you can see that at the very far right, same thing, it goes up, which means it could mean that the S&P 500 went up, which it did, but that the NASDAQ 100 went up even more, causing on a relative basis that to be a tick up. When that line moves down, it means that the NASDAQ 100 is weaker than the broad market. When we take the S&P 500 and put it into the component parts of growth and value, that's represented by SPY-G and SPY-V ETFs, you can see that at the very far upper right, it moves up. And what that shows is that growth is moving up greater than value. And using the last chart as a comparison, this would not be surprising. But it puts it, as you look to the far right, you look at the moving average, the 20-period moving average, that's a blue line, it's quite a bit above that 20-period moving average. So it's elevated from the standpoint of growth over value. The S&P 500, when compared to the small cap ETF, IWM, again, relative strength, so it's looking for what is stronger. If it moves up, the S&P 500, the broad market, is stronger than the small cap market, IWM. And to that extent, when you see the move up at the very far right, upper right, that tells you the degree to which the broad market is stronger than the small cap market. Or, said another way, the degree to which the small cap market is weaker than the broad market. Long-term government bonds, this is a 5.5-year chart. So bonds, there's a little tick up there at the end the last few weeks where it's moving up. But the long-term view is bonds are still going down, and they're going down because rates, interest rates and bond yields are moving up, or the perception is they're going to be moving up. So sometimes investors get ahead of that, but this is why I'm not in favor of buy and hold portfolios, and I'm also not in favor of bonds in portfolios at all. It doesn't mean I'm down on bonds. There will come a day, maybe, there will come a day when bonds will be in favor. I'll just say it this way. When bonds get to a bond yield of 15%, I will be the bond guy. I will be pounding the table to say this is the time when you want to buy bonds or bond ETFs, and probably bonds, because that is a great opportunity. We haven't had that opportunity since, say, 1980-ish, but I think one day it will return, and when it does, that'll be the time to buy. Until then, I think they're a terrible investment. So does Warren Buffett and Jim Rogers and Stanley Druckenmiller and Seth Klarman and a lot of other people are not in favor. And then you get to Notre Dame and Yale and other institutions. They're not in favor of bonds. And the reason is they're a terrible investment at these prices. There will come a time when they may be favorable, but not today. But yet people who are bought into the traditional buy and hold 60-40 stock and bond portfolios, they're taught that that's just what you do. Even though the smartest investors in the country and in the world, they're not buying them. So I scratch my head and think, okay, what's wrong with this picture? Okay, moving on. The dollar pulled back a little bit in the last few weeks. Weakening a little bit. I've read about that. Is that going to be a trend? I don't know. But right now it's still above its 20-period moving average. Gold had a good week. Gold had a couple of good weeks. And you can see at the far right, what is that? Probably about 2 months of upward movement of gold. An excellent chart. and it puts gold in a very favorable position. And this shows a 30-month period of time, but it shows the degree to which gold is doing quite well. Silver, the same thing, except not as impressive a chart. It moved up similarly, but it's been a rockier ride along the way. So, I like silver, but I think gold, if you're interested in buying gold, physical gold, this is, it's a very good chart. Bitcoin kind of took a pause this past week. It's been doing a little bit of a pullback lately, but it, again, over this 2.5-year period of time, has done very well. Volatility. Now, I try to not draw too many lines on this one because it's just an up and down chart. But volatility, this shows, and volatility, the volatility index, the VIX, VIX, tends to move in an inverse direction from equities. So when equities are going up, this tends to go down and vice versa. So I drew a black line, arrow here just to show for the past 6 months or so, the general direction, the trend is down, which means that the trend of equities tends to be up over that same period of time. Asbury Research, 6 metrics, indicators, all are positive. Also, Asbury Research does relative performance comparing one asset to another. So when they are covering all 3 periods of time, the last week, the last month, the last quarter, going across the page, then I cover those. And in equities, all of them were favorable over another asset. For example, going down the list, stocks are stronger than bonds. High beta, high volatility is stronger, type stocks are stronger than low volatility stocks. Large cap stocks, larger companies like the S&P 500 is stronger than small cap. The broad market, the S&P 500 is stronger than the blue chips, the narrow market of the Dow Industrials. Technology is stronger than the broad market. Growth is stronger than value. Developed markets are stronger than the U.S. Now, when I say developed, I mean developed non-U.S. So this would mean typically Japan and Europe. And emerging markets are stronger than the U.S. Emerging markets typically are the BRICS nations, Brazil, Russia, India, China, and South Africa. Stronger than, in all 3 time periods, stronger than the U.S. market. And you get to bonds, there is not a single type of bond that is stronger than the one it is compared to for all 3 time periods, which is why you're seeing everything in white. Now, when we get to the U.S. versus the world, it's interesting. The U.S. market has been softening a little bit lately, and you can see that through some of the data I've shown you. So the countries for these 3 time periods, weekly, monthly, quarterly, these 3 time periods, the markets that are stronger than the U.S. are Chile, Brazil, Mexico, Switzerland, Italy, Germany, Spain, France, the entire Eurozone, Singapore, South Korea, China, the Pacific, and the entire emerging block of countries. The only one that the U.S. is stronger than is India. When we compare the U.S., I put South Korea in here. EWY is the ticker. Again, in the last month or 2, it has been coming down a little bit, but still the U.S. is stronger than South Korea above its 20-period moving average. Silver and gold. So because that was out last week, I'm going to use 2 weeks ago data. So for 2 weeks ago, gold is up 3%. Silver is up 1.6%. The gold-silver ratio is currently 89 to 1. and I put the resources. My son's company, Preston, his company is Tennessee Precious Metals.co, and I also have bought quite a bit of precious metals in Seattle from Northgate Precious Metals, and that's northgatecs.com. So those are good resources for you if you want to check prices other than using a local retailer where you are. Okay, a monster box of silver bullion. This is a box of generic silver, not silver eagles, generic silver, 500 of them in pristine condition, $16,730. That includes a $1.12 markup over spot, which brings the cost to $33.46. Spot plus the markup. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.